right, hello everybody. I'd like to welcome you to our November 2024 Market Outlook. We wanted to thank everyone for taking the time out of their day to join us. Just a reminder that this webinar is being recorded. We want to keep things fairly informal, so if you do have any questions, please feel free to raise your hand or just type it in the comments at any time. I'll just let a couple more people in here.
So just check, Barry, I noticed you're there. Can you hear us okay? If you could just wave if you hear us okay. Perfect.
All right. Perfect.
You're very clear.
For now, we'll wait and see as I go along, but hopefully we'll stay clear.
I understand that.
All right, so for agenda today, we thought we'd start with discussion about the impacts of the US election and what a Trump presidency could mean for the markets. Then we'll dive into current economic conditions, followed by we'll have a look at our fixed income markets, then the equity markets, and then what we see, kind of how we're positioned going forward. So to start off with, we wanted to point out four main Trump policies that could potentially impact the markets. The first two are relatively supportive of the economy. The last two could potentially impact GDP to the downside. And so we'll just go through them one by one. The first one is deregulation. An example of, so we feel that Trump he is looking to kind of free up the markets in a way through deregulation. An example of this would be the Basel III Accord. So basically, Basel III rules set capital constraints on the banks. So it's rumored that they might just end this policy, freeing up the banks to kind of lend more. In addition to that, we also expect an increase in merger activity. You would note that both of these two, the Basel III and merger activity, would actually lead to would both be very beneficial for the US banks. And for anyone who did follow the banks following the election, the US banks such as JP Morgan, Goldman Sachs, and Morgan Stanley, they were all up 10% once the election results were known. The other impact would be fiscal spending. We expect that to remain high, and that will be a positive for the economy. One area of fiscal spending that a component of it would be reducing the corporate tax rates, which are currently at 21%. They could reduce this to 15%, and this could lead to significant boost for corporate earnings. Third, immigration. Now, it depends on this policy here is a little bit tricky. It all depends on how aggressive they're going to be with the deportations, and if they actually will. Well, they will, but to what extent? Bottom line is that we would expect this to be inflationary, as it would put reduce supply in terms of employment, which could lead to wage inflation, as we'll kind of discuss later on. And then finally, the elephant in the room, obviously, is tariffs. Right now, Trump's mentioned a 60% tariff on all Chinese imports, as well as a 10% universal import tariff. Now, this would be a major hit for lower income households, as well as could be inflationary and reduce US GDP.
Yeah, and I'm just going to elaborate on everything a little bit more. We, of course, had after the election, we put out an email saying we were very well set up for the Trump presidency or the Trump win. And I was asked to elaborate on that a little bit, which, of course, we were planning to, and I'm going to get to that right now. So first of all, generally, Trump's policies, of course, favor the U.S., the MAGA, Make America Great Again. He is the president of the U.S., and he is very much focused on the U.S. So why we're well set up is basically in 2008, we started investing, or we're investing heavily in the U.S., And we have been invested heavily in the US since 2008, which is, of course, the area expected to benefit. And if you look, we did very well during Trump's first presidency. We actually didn't make a lot of changes during Biden's presidency. There was not a major shift from us to away from the things we were doing during Trump's presidency. So we were basically well set up before, and we are, I very much believe, well set up going in. If you could maybe go to our next slide, Chris. So one of the, as Chris mentioned, one of the key question marks, particularly as Canadians and frankly, people living in Mexico, China, and across the world. Chris mentioned some of the companies that went up. Markets generally in Europe, China went down. Markets went down again in China when one of Trump's policymakers, who is viewed as hawkish or negative towards China, was appointed today. When we look, first of all, at the potential of tariff increases, one thing we have to remember is this was a big area of focus in 2016 when Trump was last elected. And if we look at what actually happened, there was all sorts of rhetoric. It was going to be horrible for Canada and all sorts of different things. And in reality, from the renegotiation of NAFTA, there isn't a lot that really changed. The name changed from NAFTA to Canada, Mexico, United States Free Trade Agreement, but there wasn't a lot of huge changes. Many have suggested Trump is better prepared this time around to implement changes, and let's just assume there are tariffs invoked. So when we look at what would be hit worse, what we have to look at, of course, is what is Canada export. And if you Google what is Canada export, it's a little bit confusing. You see crude oil, you see bitumen, you see refined products, petroleum products, drilling, et cetera, et cetera. I'm going to just simplify it. The bulk of our exports, first of all, are to the US. Approximately 75% of our exports go to the US. And the bulk of that is oil and related. Numerically speaking, and I was even a little bit surprised, it's been a while since I saw the numbers. Numerically speaking, it's a little bit shocking. If you build in the oil related, it's about $150 billion. If you build in, and one thing I'll say is the numbers jump all over the place depending at the source you look at, but basically oil related, $150 billion. Next closest area, auto parts, aircraft parts, 20 billion. So 20 billion versus 150 billion. And then if you build in the other commodities, gold, wheat, meat, which are the other big Canadian exports, you can see we're very much an exporter of commodities. We're going to touch on oil as you can see by the chart. That is the key export, as I said before. So is the US going to put tariffs on oil? It's a very good question, and certainly people in Alberta and northeastern BC are scared, as perhaps they should be, or certainly concerned, maybe not scared, concerned. But when we look at it, first of all, oil, they need it. A lot of people be surprised to know in July, which is the last month we have data, the United States imported a record amount of oil from Canada, 4.3 million barrels in July. So despite all the talk of things shifting, they imported a record amount of oil from Canada. What does that show? It shows they need it. So is it to their best advantage for Trump to put a tariff on oil? It's a question mark. The next thing is, if you look at what else Trump said during his run-up to presidency, he said he's going to cut the cost of energy for Americans by 50%. He's going to cut it by half. The two don't align. A big tariff on oil and increasing or decreasing the costs for consumer spending on energy by 50%. So it's not a given by any means that oil will be hit with tariffs or any of these other commodities. Again, going back to the last agreement. Further to that, a little bit on our portfolio, we don't own a lot of commodities. We have a small weighting in a Canadian oil name. Majority of people, not people that don't want to own oil, but small weighting Canadian name. Again, oil may not necessarily be affected at all. And then we have two drilling companies, which, as Trump said, drill, baby, drill. That is one of the areas that is going to benefit. So kind of cutting to the short of it, we don't own any of the companies that are particularly vulnerable. We don't own an auto parts exporter like a Magna. We just don't own these types of companies. We own, like Chris mentioned, companies like JP Morgan that went up 10% when Trump was elected. And I expect us to do very, very well with our portfolios. One at this time, we're going to move on to the next topic because we didn't want to spend, well, anyway, we're going to move on to the next topic. But before we do, does anyone have any questions about Trump being elected, their portfolios as it relates to that? We'd be happy to take them right now. And you can either, quote, raise your hand at the bottom of the screen. You can just plain speak up, and I will allow a minute for that.
So again, if you do have any questions, feel free to type it into that chat feature there. So that's one way of doing it. Or if you just want to unmute yourself and ask away, we'll give just a couple seconds just in case someone wanted to ask a question but forgot to unmute. Okay.
What can Biden do
Sorry.
during the remainder of his presidency?
So the question, Chris, was what can Biden do during the remainder of his presidency? Which is interesting you bring that up, Barry. It's as most people are aware, there's an interesting, of course, in Canada, our power changes very quickly. Trump, in essence, won't take office till approximately January 2025. So it's a great question because we have a long lingering period in there.
Yeah, personally, I don't expect any changes. Any changes in policy would have been set ahead of time. Obviously, they were hoping for that Kamala would be able to carry the torch, but that has changed. Going forward, most of their policies are set. You'll notice that a lot of the Biden policies that from the beginning of his term, a lot of the economic policies were actually a continuation of Trump policies, whether or not it was they're going back in terms of addressing the border. He kept all of the tough stance on China kind of remained. So we don't think that there's going to be a lot of changes coming from the last couple of months of Biden's presidency.
Thank you.
My pleasure. Good question, though.
We have another question was typed in, Chris. Oh, and this is actually a good one for you, Chris. It's a question related to Bitcoin. Do you see it there, Chris?
Yeah, I do. Okay, so Bitcoin's very interesting. It's very, very hard to value, obviously, because what is it, right? And so, looking at all of the studies that I've looked at, the one thing that Bitcoin correlates to very, very well is global liquidity. So this is essentially, you look at central banks and their influence through monetary policy, whether or not it's through quantitative easing or even through just money printing or running huge fiscal deficits. Any form of liquidity, Bitcoin tends to correlate to very well. Now, obviously, there's rumors with JD Vance being venture capitalist and really big on cryptocurrencies. I believe that Trump's going to hand him the portfolio in terms of what happens there. But in terms of Bitcoin, obviously it's extremely volatile, and its case use hasn't quite been, it hasn't stood the test of time like other inflationary products like gold or commodities or equities for that matter. But obviously with the run-up in Bitcoin, because Trump was said to support it, he was at the Bitcoin conference this past year. And obviously, because of that, we've seen a run in Bitcoin over the last, since Trump won the election. Yeah. Good question. Thanks, Ray. Anybody else have any questions so far? Otherwise, we'll continue. All right. So moving along. Looking at the Canadian economy, you can see that things are improving, albeit very, very modestly. In the second quarter of this year, Canadian GDP grew by 0.5%, following a rise of 0.4% in the previous quarter. The growth was primarily driven by a 1.5% increase in government spending. So the Canadian government spending helped lift the Canadian economy. This was offset by a slowdown in household spending. And so, bottom line is that we are, very, very modestly positive. But the bank does expect GDP for 2024 to come in at 1.2% and then accelerating to 2.1% in 2025. One thing I want to point out, though, is looking at all of these quarters, you have to go back to the end of 2022, beginning of 2023, for when we had an actual quarter where we actually had a GDP growth of over 1%. So if we compare this to the U.S. economy, the U.S. economy is starting to see a little bit of a, it's still very, very strong, although it did decrease very, very modestly. But you will point out how it's been spectacularly strong since the pandemic.
So one piece I want to point out here is hopefully you saw between the two charts, the U.S. economy has been stronger. If you go back a year or two ago, that's exactly what we've been saying. We were saying the risk was to the Canadian economy because one of the biggest drivers of the Canadian economy is housing. It's a big driver of the U.S. economy as well, but in the U.S., we had a record number of people locked in to record low interest rates. So the U.S., for those that aren't familiar, you can lock into a 30-year mortgage, and many people locked into rates in and around the 2% range.
Yeah, sub three.
Sub 3. And in Canada, we had a record number of people that were floating sub 3, but they saw their mortgages go to 5, 6, 7%. So the risk was on the Canadian economy, which was part of the reason a lot of your money was directed towards the United States. And then also the upside. We expected the U.S. economy to do better, which it has. That was reflected in your performance. Last year and over the last year and a half, the U.S. stock market has done roughly double what the Canadian stock market has done. And, that has benefited us very well, the positioning in the U.S. again. One other piece, just before we move on, ironically, the weakness in the Canadian economy, you could argue, is going to somewhat save Canada. And what I mean by that, and a strange statement to say, but because the Canadian economy has weakened and inflation has softened, although again, we're always a little careful those terms, it's far below the 9% or higher than it was, running around 2. But as Chris pointed out, one of the big drops was in the price of gasoline, and the price of food is still high. It's in the 3% range. So when we say inflation is down, some people are going to raise an eyebrow to that. But because of the weakness in the Canadian economy, it has allowed the Bank of Canada to bring down interest rates aggressively. That has allowed likely the ability, I'm going to talk about this a little more later, to avert the mortgage crisis. People had their mortgages that were floating at 2 and a bit. They saw them go as high as 7 and a bit, depending on what type of mortgage you had, and now it's drifted downward. So again, ironically, the weakness in the Canadian economy is going to hopefully help save Canadian housing, avert a mortgage crisis.
Yeah, good point. And just as a footnote to that too, for people that are looking to renew their mortgages this year, that are going from 5-year fixed into this current rate environment, I think the studies show that I think there's still expected that mortgage costs to increase about 20% if you're renewing in 2024 and 2025. That was based on the studies that we read. Anyways, moving along, the Eurozone, outside of North America, we're starting to see economic activity also pick up in the Eurozone. You can see it's very tepid as well, still modestly above 0, but still at least moving in the right direction. In contrast, the Chinese economy hasn't quite recovered since the pandemic. So the Chinese economy has continued to struggle. They're currently suffering from a balance sheet recession from overbuilding in real estate, So they're going through their financial crisis right now, which we saw in 2008, 2009. They're kind of in the process of going through that right now. Recently, the government announced both fiscal and monetary stimulus. They're trying to help stem support their economy, but it remains to be seen whether or not they can throw enough stimulus to turn things around. Looking at Canadian inflation, the annual rate of inflation fell to 1.6% in September. This is down from 2% in the previous month. Note this is the lowest rate of inflation we've seen since February 2021. The sharp decline in inflation was mostly attributed to the lower price of gasoline. One thing that's worth noting is that food prices were still up 2.8% over this period. So although inflation is coming down, obviously food is also a very important basket. That continues to be above the 2% target. But overall, the inflation rate is now within the Bank of Canada's 2% target range.
So this slide's one that I wanted to show. It's the Canadian Consumer Price Index, or CPI, which is one of the numbers commonly referred to when they talk about inflation and that sort of thing. It's basically the price of a basket of goods. It's how much it is basically cost you to live, buy your bread, all those different types of things. And if we look at the red line on the far right, what we've got basically is because of COVID, the price of everything increased. And that's obviously understandable. We had a lot of problems. Everybody's aware, from ships being locked in ports and China workers. We don't need to rehash COVID. The unfortunate thing, though, is as COVID subsided, the price of goods has not necessarily come down. It continued to rise. Now, the yellow line on the left is kind of interesting. That's 1991. That's the last year a Canadian team won the Stanley Cup, the Montreal Canadiens. Now, the interesting thing there, it's not also, I didn't bring it up because last year a Canadian team won a Stanley Cup. From 1991 to today, the price of goods approximately doubled. So over that 33 years, the price of goods approximately doubled. That's partially because of after 2008, we had inflation running in and around 2%, subpar. It's only recently that it spiked. The interesting thing is we were running a couple of years ago 9% inflation. And to give you an example of what happens with 9% inflation, in that time period from when the Montreal Canadiens won the Stanley Cup to today, if they hadn't raised interest rates aggressively, and interest rates, let's just say 1991, if inflation rates had been 9%, instead of the price of goods doubling, it would have gone up sevenfold. Viewed a different way, at 9% inflation, it would take 8%, 8 years for prices to double. So that's just a kind of pointing out again why it is so, inflation is such a concern, and why the feeling was that it had to be fought so aggressively. The next chart we're looking at, and there's a reason we're bringing up a lot of charts to do a debt deficit, and I hate to say it, there's more to come. It weighs, we're going to talk later on the slides about how it weighs into investment decisions, but when we have numbers like this, it weighs into everything we do. It affects the bonds we buy, the duration, it just weighs into absolutely everything. So we wanted to kind of touch on the federal debt again. If we look at the first red line, this is basically, so actually going back in time, of course, debt went up fairly minimally, particularly compared to today's numbers. And then in 2008, it spiked up. That was the financial crisis, and it would be expected that debt, would spike up. As Bernanke said, he basically had to throw money from helicopter in the sky to keep the economy on track, avoid depression. Ideally, we would have liked to, or not more than ideally, we would have liked to have seen debt flatten after that point or come down, but it hasn't. We saw debt spike up during 2020 COVID, which again would be expected, but we look at the trajectory there, it's extreme. And what's even worse, it has just continued. The spending, the debt is just, it's it reminds me of Seinfeld episode where Kramer says to Jerry, "We're out of control. We're out of control, Jerry." And the first thing when I looked at that slide, it just reminds me of that. And we are going to be talking about it more, as I say, it affects our decisions. So we just wanted to bring that up again.
Yeah, one thing worth noting on this chart as well, you can really see the difference in slope from prior to the financial crisis, then after the financial crisis to COVID, and then from COVID onward. That slope of if you look at the trends, it's just going up exponentially. Now, looking at the Canadian government debt levels, you can see that after the financial crisis, yeah, they spent, the debt level went up a bit, but it stabilized. And if you remember, the Canadian banks were the best funded banks during the financial crisis. So there was no Canadian banks that required a bailout during that time. So that that kind of kept things in check. But following COVID, obviously, Canada's that trend, the spike has been significant in terms of, especially in order of magnitude. You can see that spike up quite dramatically. Now, going back to the U.S. budget deficit, in 2024, the U.S. federal government spent $6.75 trillion. So that was how much the government spent. They collected $4.92 trillion in tax revenue, but that resulted in a $1.83 trillion deficit.
And I just want to touch on that a little bit further. The problem now, I remember when it wasn't that long ago when we hit the $1 trillion mark, and it was talked about how most people couldn't comprehend that. It was just so many zeros. You know, all of us are somewhat familiar with $1 million. Most people have somewhat of an idea what $1 billion would be. $1 trillion, when they do studies, most people just can't grasp what the heck that is. It's just too big of a number. So I wanted to go at it a little bit of a different way. I knocked a bunch of zeros off of this, and how it equates, if you use round numbers and you knock a bunch of zeros off, this is the equivalent of you or the government earning $50,000 a year and spending $68,000 a year. So I can tell you right now, none of you have done that because you're clients. You're all net savers. If you weren't net savers, we wouldn't be on this call together. So that's what the government is doing right now, is earning approximately $50,000 via your tax dollars, and they're spending approximately $68,000, and there's no sign of slowing in place. You know, every year after year after year, we hit these debt ceilings in the United States. And yeah, it's not a good thing. But I also want to summarize all these charts about debt and deficit and spending. Again, there's nothing good about it, really nothing good about it. And some people have called it unmanageable. That's not necessarily true. And the reason I say that is there's basically two ways you manage this debt load. And one is low interest rates. So we talked about this a few years ago when the last time we had a debt spiral, and we were talking about debt spiraling out of control. And one of the things we saw back then was interest rates in many countries were zero or negative. Interest rates in Japan have been essentially zero for almost 40 years. So part of how this can be managed is low interest rates. If the debt is 1 trillion, 10 trillion, 100 trillion, if interest rates are zero, your interest payment is zero. Now, that doesn't mean rates are going to be zero, but for better or worse, interest rates at 1, 2, 3%, a large debt load is still manageable. That doesn't mean you pay off the debt, as we saw by the deficits. It's expected to continue to grow, which is not good. But that's part of how you manage the what they call the service payments or the interest payments. That's how basically the country stays alive. The other part of it is monetizing the debt. So this is again where the inflation, and we're going to talk about this again and again, the inflation fears come up. If the government allows inflation to slowly creep up, basically, you know, we saw in the last chart, 1991 to today, the price has doubled. So let's just say debt was $1 trillion, it'd be worth 500 billion in past dollars. So if you allow inflation to creep up, you make that debt less and less impactful. So what we're getting at here is don't be surprised to see inflation slowly creeping up. It's something very much we're aware of, and it's something we're very cognizant of when we're building your portfolios. The other thing, it's a great time. So Chris mentioned before, and maybe I should ask before I move on to the next topic if we have any questions on, and I'm going to speak about gold more in a second in case anybody's wondering about that. But in terms of debt deficit, I will ask at this time if there's any questions. And again, unmute, type in chat, any of those features. So I'm going to leave it with you a minute. I'm going to move to the next part of the same topic, which is gold. When we talk about debt, inflation, one of the questions was asked about crypto. Gold is quite often asked about as well. So gold has done very well. One of the other reasons Chris mentioned for crypto, and this is also applicable to gold, is just to measure liquidity. When there's a lot of money, and despite the fact of talking about debt at the government levels, there is a lot of money, and we do have a question coming up, Chris, too, typed in, but there's a lot of money in many people's hands. That's why things like these non-fungible tokens, this digital art went up in value. That's why crypto is going up in value. And that's part of the reason gold is going up in value is there is a lot of money in the world, and people are saying, I'm concerned about the debt. I want to maybe put 1% of my money here. Maybe I'll put 0.5% of my money in crypto, which is moving these currencies or these products. As it relates to gold, this is an area that I say Chris follows very closely. This is an area that Chris a couple of years ago said, look at, China's buying a lot of gold. We are seeing people concerned about inflation. And Chris, we didn't want to overwhelm with charts, but Chris says charts, money flows going into gold. And at that point in time, plus we also had another event. We had the Russia invasion of Ukraine. And that was another I hesitate to use positive for gold, but there was another validation towards gold. And what I mean by that is if you're a Russian, ordinary Russian, you saw the value of your ruble decline dramatically. So, you had your life savings in rubles, it declined. If you owned gold, you somewhat kept your value. If you were an oligarch, you may have had your money flat out seized. In many of the countries of the world, their money was flat out seized. So again, you have some gold around your neck, in your pocket, in your backyard, wherever it is, you have that. So it again encouraged the flow of money towards gold. So that's one of the reasons back in 2023 on Chris's urging, we doubled our weighting in gold and we added a little bit more recently. So the client question was actually, how much gold do we own? And that's an easy question to answer on the surface. Click a button, say you own 16% gold or whatever the number is, but it's a little bit more complicated than that. Gold, first of all, on your statement, it shows as, quote, other. Majority of people hold it through iShares, BlackRock, Gold, Exchange Traded Fund, or ETF, but it is considered an equity. And one of the reasons is it does not have a maturity. It does not pay a dividend. It's not like a bond where if you paid $3,000 for gold tomorrow and the price happened to go down, you're not guaranteed to get your $3,000 back. It's not fixed income. So it's an equity. So the first thing we look at when you ask how much gold do you own is what is your investment profile? So if you're a conservative investor, you have approximately a third of your portfolio in gold, of which gold is a portion of that. The amount of money you own in gold would be far less than an aggressive growth investor who has a lot of money in equities and hence would have more money in gold because it is considered an equity. In terms of this client's question, being a balanced income account, one of the other pieces I wanted to point out as well, if you look at the dollar value, it may not on the surface look huge, but it is twice as large as one of your largest holdings, what you would see, which would be Royal Bank. It is 3 times as large as CP Rail, holding a CP Rail, just to kind of put things in context. But it's not an overwhelming number. And part of the reason that is also when we're talking about gold, as I said, we're also talking about inflation. And as Chris mentioned earlier, our equities have done very well during the last few years in an inflationary period. Chris predicted or mentioned a couple years ago in one of our webinars that we expect equities to do well in an inflationary environment, but with a lag. And Chris was very careful to point that out in bold letters. So inflation first reared up, our equities actually went down in 2022. But when we look at the inflationary period 2022, 2023, 2024, our equities did very, very well. They did exactly what they were supposed to do, protect you from inflation. They went up far more than inflation did. So the other way you're protected is far beyond gold. It's actually owning actual companies. So again, the simplest example, we've used it before, I'm gonna bring it up again, is Visa. You went to the store, you spent more money on bread. Visa gets roughly a 3% cut of that. You spent more money, they took a bigger cut on it. You went to the gas pump, the price of gasoline went up, Visa took a bigger cut of it. Not surprising, the price of Visa has done very well. Our stocks, by and large, done very, very well during this inflationary environment. So I just want to point out gold is not our only hedge against inflation. And one might, and I would suggest, equities are really are one of our key or our core whole protections against inflation.
All right, so I just want to address the question that we had, and the question was, do you anticipate that Trump will focus on lowering the debt levels? I know there's been talk that he's going to let Elon Musk loose in terms of looking for areas to cut. He can try, but if what I'm looking at is the big pillars of the U.S. spending, and if you look at entitlements alone, entitlements being social services, Social Security, Medicare. So if you were to look at entitlements as well as debt servicing, as well as military spending, now they can't really cut entitlements. Like those things are in. They can't cut that. They can't cut debt servicing. They could do a little bit with defense, but based on what's going on right now in the world, we expect defense spending to increase globally. And so if you look at all three of those components combined, they're already over the tax revenue that the US government collects. So while he at the margins, they may be able to cut here and there. If they continue spending even 4 or 5% budget deficits as percentage of GDP, we think that it's kind of past the point of it's going to just keep on rolling. So just to put things in perspective, if you look at the interest cost of US debt, the interest alone on the US debt, which is now about approaching 36 trillion, every 90 days the interest cost goes up by an additional $1 trillion. It's just the math. So they can try and cut, but if you look at the entitlements alone against their tax revenues, we see it's going to be a very difficult challenge for them.
And sorry, I'm just going to elaborate on that a little bit further because Chris raised a very good point about entitlements. And the one problem is, and I've mentioned this before, Arnold Schwarzenegger wrote a very good, there was an interview in Vanity Fair with Arnold Schwarzenegger. It was an excellent article. And he talked about the fact that as a politician, the politician may want to do the right thing, but basically when politicians cut things, so if President Trump was to cut Social Security or unemployment insurance or any of those things, good luck getting reelected. While we talk about cutting the debt and the deficit, the suggestion is that we vote differently. And it's a little bit like, I've seen the question asked and a little bit off topic, but with food companies, why do you not produce healthier food? Everybody wants to eat healthier, wants less sugar, etc. When they've actually done studies and they've done these things, people don't act with their wallets. They don't buy these things. So it's difficult, as Chris said. When you start talking about cutting entitlements, it's difficult. It absolutely needs to be done, but difficult.
Okay, so as much as we're concerned with the high levels of government spending, something that is very, very important to remember, that fiscal spending is very stimulative for the economy. So although we see issues with the levels of government debt levels, at the end of the day, they can continue to print, which means that it could be an issue with inflations, but it will also stimulate the economy at the same time. So absent what's going on in the government balance sheets, household balance sheets remain extremely robust. So I know this is a lot to go on here, but I'll walk you through it very quickly. If we look at the health of looking at the health of U.S. households, we see in the top chart that household checkable deposits are at all-time highs. In the second graph here, we see that household cash positions are near all-time highs. The third, we see that not only is the U.S. household debt levels coming down, the percentage of floating rate debt as a percentage of total debt is very low. So remember that they were able to lock in 30-year mortgages sub 3%. That's keeping their debt costs very low. And then finally, the last chart in the bottom here, we show debt service ratios, which are extremely low, well below where they were in the prior decades. Looking at corporate balance sheets, it's very similar. The very top, we see corporate checkable deposits are at all-time highs. Corporate cash levels are near all-time highs. The level of floating rate debt as a percentage of total debt is low. And again, their debt service ratios are very low. So from an economic standpoint, looking at if we think that consumers are healthy, businesses are healthy overall, it's a Goldilocks period for the economy. So as we mentioned before, we have GDPs going up and is strong in the US. We have inflation coming down. Corporate balance sheets, household balance sheets are strong. It's an ideal time for investors. Digging a little bit further, what we have here is a whole bunch of indicators. So if we were to aggregate the last 12 business cycles, okay, looking at how all of these indicators do leading up to and after a recession. So you see at the middle here, we have time zero. This is when a recession starts. These negative numbers here are leading up to a recession. The positive numbers are after a recession. So if we were to aggregate corporate profits, for example, over the last 12 business cycles, you can see that they actually start to go negative. They're one of the first leading indicators. They go negative about a year before a recession actually hits. Then we see growth kind of slow, followed by net worth. And note that at the time a recession begins, the growth rates of the S&P 500 earnings and gross domestic income both start to turn negative. Okay, so this is looking at historically the last 12 business cycles, the trends that we see. Things happen in a sequential manner. Looking at the current economic data, we see corporate profits still accelerating. Growth is still above zero. We do not see a recession happening anytime in the short to medium term. So again, we can't stress this enough. This is a great time to be invested. The markets are in a Goldilocks regime. All major central banks, Federal Reserve, the Bank of Canada, the Bank of England, European Central Bank, even the Chinese central banks, they're all lowering interest rates. Fiscal spending remains high, which is supportive for the economy. Both aggregate and business balance sheets remain very healthy, and corporate earnings growth continues to look very robust. On the downside, however, valuations are historically high and obviously vulnerable to temporary pullbacks, and sovereign debt levels are reaching concerning levels, and possibly at some point could reignite inflation at some point.
So the next topic we're going to move to is fixed income or bonds. And I'm going to answer first a client question was emailed in, which again, we absolutely love when clients email in questions. We love to really focus the webinar on you. And we did a lot of rewriting on the webinar basically because we wanted to make sure, based on client questions, we covered everything that you wanted to talk about. So the client question was, if the value of the Canadian dollar declines significantly, how will our portfolios handle it? So it's interesting. It's actually a somewhat complex question. And the decline of the Canadian dollar and how your portfolio will handle it. First of all, let's talk about an ultra-conservative investor. It's going to be the simplest example. So an ultra-conservative investor is basically going to have all their money in bonds or GICs. They are going to own it all expectedly in Canadian dollars. So if the Canadian dollar declines, does it actually affect them? They had Canadian dollars. They're spending Canadian dollars. Their income is in Canadian dollars. If the Canadian dollar declines, their portfolio value does not actually drop. Now, you could definitely say they missed out on opportunity because they would have actually had gains if they had US dollars and the Canadian dollar dropped, but it didn't. The simple answer is it didn't affect their portfolio. Now, that's on an ultra conservative investor. So they miss out, and the idea there is that there's a minimum of volatility. If we look at, for instance, a balanced investor, half of their money is in stocks, roughly speaking, half their money is in bonds. Roughly speaking, 2/3, 70% in that range of the equities are in the US, and roughly 1/3 is Canadian. So for a balanced investor, half your portfolio would be in stocks. Roughly 70% of that would be in equities. So about 35% of your portfolio would, in this case, if the question Canadian dollar declines, would benefit from that decline. But again, we have to be very careful in the wording because, how does the Canadian dollar affect your portfolio? It all depends how you're invested. If you're conservative or ultra conservative, no effect. If you're conservative, a little bit of effect. If you're a growth investor, you would get quite a bit more profit from your portfolio if the Canadian dollar declined. And the biggest reason that the dollar exposure is weighted into equities versus bonds is we don't want to, what they call, do currency speculation. So when we own US equities, it's for more reasons than just potential expectation of the US dollar. It's because we think Microsoft is a great company. We don't have a Microsoft in Canada. We think Amazon's a great company. We don't have an Amazon in Canada. We expect that these companies, the growth and the performance of them is going to mitigate any change in the currency. So even if the US dollar went down and the Canadian dollar went up, we still expect that these companies are going to outperform. When we go to bonds or GICs, it's a very different story. If you're earning 4% on your bonds today, and let's just say, for example, the topic right now is Canadian dollar depreciating. But let's just say, for example, the war escalates in the Middle East, the price of crude oil shoots up, and the Canadian dollar actually rises. The Canadian dollar goes up, the US dollar declines. A conservative investor, if their money was heavily weighted in the US dollars, and all of a sudden they see a loss in their portfolio, it's supposed to be bonds, GICs, you're looking saying, what the heck is going on? And the answer is there was speculation with your currency. So we don't speculate with currency. We do try to diversify within the efficient risk frontier, but we don't want to speculate on currency.
Okay, so we have another question. The question is, if household balance sheets are so strong, why is so much of the US election based on people not being able to feed themselves? Great question. Fantastic question. Thank you very much for asking that. So I had a chart here, but we because of time, we actually got rid of it. But what it showed was the top third. So if you were to divide the consumers, the US consumers, into the lowest third, middle third, and upper third, the upper third is responsible for over 50% of consumer spending. The bottom third represents 15% of US spending. So there's that huge difference there. And so obviously with the inflation, it did hurt. What inflation does, it kind of increases the poverty line as inflation kind of takes away. So slightly more and more people go below the poverty line as inflation kind of creeps up. And yes, those people that are in the bottom third are having a very tough time. That being said, they do not drive the overall economy. The overall economy, like 50% is driven by the top third of the consumers in the US. And so again, part of this wealth disparity This is what it's coming down to. And maybe, we've totally sympathized with those people that are under that poverty line and feeling the effects of inflation. But bottom line, when it comes to the overall economy, it's driven by the upper 2/3 of consumers. All right, so moving along to our fixed income here. So in this last meeting in October, the Bank of Canada cut its key interest rate by 50 basis points to 3.75%. It signaled that it will continue to lower this rate should the economy, continue to, as we showed, it was just barely above zero, but increasing. So we do expect further rate cuts. Now, remember that inflation is below the 2% target. So this gives room for the Bank of Canada to cut rates. Now, looking at where rates are right now, you'll notice that we have a line here looking back at the long-term average of 3.5%. And so at 3.75, we are very close to that long-term average. Now, last Thursday, the Federal Reserve cut their benchmark overnight rate by a further 25 basis points to 4.5%. If you recall, this followed a 50 basis point cut in their September meeting. Now, looking at corporate balance sheets, they remain strong, as we just showed. Now, for bond markets are also strong, as we measure this in the form of credit spreads. So what are credit spreads? They're the difference between the yield of two bonds with the same maturity, but different credit qualities. So typically measured against a government bond. So another way to think of it is the premium. A credit spread is the premium that you are paid for owning a corporate bond versus a government bond. Now, looking at credit spreads here, we show the credit spreads in both Canada and the US investment grade credits. Credit spreads, now we predicted in our over the last couple of webinars that we expected the US economy to be stronger than the Canadian economy. This is evidenced by the chart above and the fact that the Canadian spreads are a little bit wider than US spreads. So this signals that bond investors expect economic conditions to be a little bit weaker in Canada versus the US. Looking at high yield credit spreads. So high yield bonds represent the most riskiest bonds that trade in the market. And you can see that the spreads are near historic lows. This suggests the markets believe that the underlying economic conditions remain robust. But with the spreads at historic lows, however, we have minimal interest in investing in this area because we don't see any value. Now, looking at the yield curve, there's a couple mixed signals here. So if you recall, when the Federal Reserve cut interest rates by 50 basis points in September, with the U.S. market being really strong, caught some of the market by surprise because they're expecting just a quarter point cut. So this kind of begs the question: is the Fed just normalizing its interest rates to bring it down to now that inflation's kind of closer to its target? Or do they actually see weakness in the markets that others don't see? Our view is that the primary focus is no longer inflation, but or wage demands, but rather they're trying to kind of pad the economy away from a recession. Now, while they cut short-term interest rates, long-term rates actually went higher. So that also begs the question as well, whether or not the bond market was pricing in higher growth / inflation, or whether or not the Fed was losing influence at the back end of the yield curve because of their high deficit spending. So on September 18th, when the Fed cut their benchmark overnight rates by 50 basis points, you can see here that leading up to the cut, so the cut happened on September 18th. Just prior, you can see the blue line here. This was kind of like the shape of the yield curve just prior to the cut, But right after the cut, you can see how short-term rates kind of went down, but long-term rates went up. Now, it didn't really catch us by surprise, because we did invest in longer-term bonds about middle of beginning of 2023, where we jumped in to kind of secure rates around 4.5 to 5.5 earlier, so locking in much higher interest rates for our clients.
One quick piece I want to touch on here. The news always reports Bank of Canada dropped rates 50 basis points, 0.5%. Unfortunately, that's all they report. And really what they should say is the 5-year bond rate or interest rates went up 0.5%. And we often get the question from clients, with interest rates coming down, should we do this? Should we do that? The thing is, interest rates are not necessarily coming down. It depends what you measure. On the short term, as Chris said, Bank of Canada, Fed dropping interest rates. Longer term rates have started to move up because of fears of inflation. This slide, I think we'll move along with, is just talking about the fact that the Bank of Canada and the Federal Reserve, we believe, have changed their focus a little bit. If you go back a year or two ago, we heard inflation quelling wage demands. Now what you hear is inflation is close to or has reached its target. And we very much believe that this is to avert, when we're talking about Canada, this is to avert a mortgage crisis. And with the renewals, so there's less and less and going to be less and less focus on wage demands. And I would suggest that's evidenced by any one of you turn on a news channel at any time. All we hear is strike, labor strike. And the central banks don't seem to care anymore. They, in particular Canada, the key focus is getting interest rates down, avoid the mortgage crisis.
So in our last webinar, we discussed the various states of inflation. So currently we are in a disinflationary regime. This means that inflation is still growing, albeit at a slower rate. Now, I know a lot of people out there, they want prices to come down, which is deflation. But based on our studies, looking back at the last, again, 12 economic cycles, we can see inflation here, which is in pink, is a very lagging indicator. In fact, deflation doesn't come down until about 1 year after a recession. So our base case, to put this another way, unless we see a recession, we do not expect we don't expect a deflation or falling prices. We continue to expect either disinflation or inflation absent a recession. Sorry, what was that?
Oh, I was just thinking we could probably go directly to our key theme of fixed income.
Okay. I did want to just point on this very quickly. So you can see here in terms of, so if we look at leading economic indicators for inflation, I wanted to quickly point out that right now the Fed's cutting rate with inflation bottoming at 2%, which is the blue line there. And you can see that other measures are also in the process of bottoming, but at rates higher than 2%. So this is where, in terms of inflation reaccelerating, like for us to average 2%, obviously you need inflation to go below. But if it's bottoming at 2%, it's going to be very tough to average 2% inflation. One thing I did want to mention, so with inflation going up, and this chart demonstrates the correlation between stocks and bond changes as inflation levels change. And as inflation moves above 2%, around this level here, the defensive benefits that bonds offer portfolios diminishes. And that's because the correlation of bonds and stocks turn positive. Put another way, as inflation moves higher above 2%, the diversification benefits that bonds offer goes down. So in order to protect your portfolio from an inflationary environment and to reduce volatility, We need to introduce other asset classes like gold, commodities, energy infrastructure plays that generate income from hard assets. Why not? So what are we doing? We're taking advantage of volatility in yields. So when we see yields above 4.5%, we're looking to extend our bond ladder out to 2030 or 2031 bonds as yields go above that level. We're sticking with quality. And for tax efficiency, we're we're actively pursuing bonds that are at a discount. And effectively, what that means, it allows you to keep more of your after-tax money into your pocket, just like we discussed in our last webinar. Bonds that are at a discount, you're actually getting your gains in the form of capital gains relative to interest income, which is taxed more favorably. Now, I want to take a quick victory lap here. In mid-2023, when interest rates were at its peak, we loaded up on 1 to 7 year bonds, locking in yields close to 5%. So not only did we lock in rates that are considerably higher than today's rates, as rates have come down, we're now sitting on significant capital gains in many of these positions that we hold. So in terms of our bond positions, we're very happy with how we currently sit, and we're more than happy to ride them out to maturities, but we'll be opportunistic as we see bond yields kind of rise. We'll look to ladder out.
So we had a client question was emailed in related to bonds, and it said bond returns are expected to increase. How much should we hold? So first of all, in terms of bond returns expected to increase, Chris and I wouldn't necessarily concur with that. A year and a half ago, we were saying bonds are going to do very, very well. We expected them, they had taken a big drop. We were absolutely expecting them to recover. We wouldn't necessarily say that bonds are expected to increase today. Part of the reason is because of inflation. Bond investors might demand a larger premium. People are not comfortable loading up on bonds today with the worry that their value could be eroded in the future. There's a bit of a paradox here in that at the same time, central banks have to keep interest rates low, as we said earlier, to manage the debt. So our bond holdings are relatively neutralish today. If you're a balanced client, roughly half your money is in bonds. We're okay with bonds. The idea is to hold them maturity, but we're not overweighting them. We're not, you notice we didn't mention anything about, extraordinary time to buy them, capital gains. We expect you're going to get what you get, which is around 4% yield on them.
Just wanted to pause before we continue to see if there's any questions. If anyone had any questions at this point in time? Okay, I'll keep moving along. So obviously the equity markets have been very strong. The S&P record highs. NASDAQ record highs. The S&P TSX are also at record highs. As we covered already, it's been like the U.S. stocks have been absolutely resilient. Again, household, corporate balance sheets are very strong. Valuations are historically expensive. So the challenge for us right now, it's very hard to find high quality growth companies that are attractively priced. So if you look at valuations on a historic basis, this is the S&P 500 price to earnings ratio. You see the spike here. The big spike that kind of goes off the chart is actually during the financial crisis. Because earnings collapse for a lot of companies, this is why the PE ratio spikes so much. This spike just over the, this was the tech bubble here. Oops. Around these levels. And you can see that historically we are still really, really high. In fact, valuations are currently in the 97th percentile in terms of trailing PE ratios. So put this another way, this means that only 3% of the time in history have stocks been more expensive. In terms of key trends that we see in equities, interventions by central bank and governments have extended or even blurred the business cycle, arguably going back to the 2008 financial crisis. We do see unemployment is picking up in Canada. And in the US, some leading cyclical indicators are also starting to show some weakness, specifically employment in the manufacturing cycle. But again, those are very early leading economic indicators. We are seeing pockets of deflation in certain areas such as goods. However, they are being more than offset by service prices that are remaining stubbornly high. Sectors that are doing well are also benefiting from government spending. We expect this to continue. However, at the margin, we see capital investment is starting to slow down. And obviously, with valuations so high, I just want to remind everyone that market corrections are part of the investment process. In fact, we welcome opportunities to add to these best-of-breed companies and global leading companies that we own. So what are we doing? Now, this is just a copy and paste from our last webinar. We hate to sound like a broken record, but as long-term investors, our investment process doesn't usually change from quarter to quarter. More importantly, our investment discipline doesn't really change from cycle to cycle either. But we focus on these metrics that point to profitability, flexibility, and strength for the companies that we own. And we like to focus on quality, similar to bonds. As an example of the companies that we like, that we own, all industry leaders have all done really well over the last 52 weeks.
What we'll do now, we'll turn it over again to questions for anyone. So again, just please speak up, unmute your microphone, speak up, or type in a question by all means, please.
I turned it on. What has happened? Now, you never mentioned either Israel or the Ukraine. What effect, and I don't know if this is a polite question, but what effect does that have on the market?
So I'll touch on Ukraine. Being Ukrainian, I feel a little more freely to speak on that. In terms of the market, it's interesting. There is all sorts of embargoes were supposed to be placed, on Russia and that sort of thing. And it's fairly well known knowledge that ships are reflagged in Greece, and crude oil gets to India or China, and then from there it gets to other areas. Same thing in terms of goods getting into Russia. Goods are shipped to Turkey, and then from Turkey or other countries, I shouldn't single out Turkey or other countries, they make their way to Russia. So as far as economic impact, the effect on their economy is Russia's economy is somewhat debatable. Obviously, from a human rights point of view, it's a huge issue. But as far as economic growth outlooks and that sort of thing, really the big takeaway from that would be a lot of money is being spent on defense and defense stocks. But beyond that, I hate to sound crass, and again, I'm Ukrainian, which is part of why I wanted to comment on it. It's a huge issue from many perspectives, but economically, it's not the biggest issue we've ever seen. I hate to say it, but
now typically, anytime Iran's involved, you see spikes in oil. Currently, however, there is a lot of spare capacity in the markets for oil. So just as an example, Saudi Arabia, they have 3 million barrels a day of excess capacity that they can turn on. And so when Israel decided to respond with their attacks on Iran, you didn't even see the oil markets flinch at all. And this is a result of the oversupply that we're seeing in the markets. Like Leon said, obviously they're both humanitarian disasters that we're seeing in both regions, but from an economic standpoint, they don't have much of an impact.
It's a very interesting comment about the actual oil revenues, which is a large part of our exports. When will we run out of oil? When will we run out of gas? This goes back into the early days of the Mediterranean, when I believe it was one of the trading groups who went on to either Cyprus or Crete and basically used all their trees to build ships. And then when it was all done, they left. It's now a rocky island. I'm not quite in favor of supplying unlimited oil to the rest of the world. Is there any opinion out there that confirms that?
Sort of the opinion on supplying unlimited oil, or when does our oil run out?
Well, both actually. I don't think you can tell when the oil will run out. But where it's going and why we are constantly bombarded with people who say we've got to move our oil or our gas to somewhere in the east, into Japan, into Cambodia, into Vietnam, etc.
Sure. So I'll touch on both of those. So as you said, in terms of running out, it's interesting, each time we appear to get low on oil, the price goes up and technology improves, right? It was the multi-stage, it was horizontal drilling, it was multi-stage fracking. Now, one of the things they're saying, there was the blowout in the Gulf of Mexico, basically because the well was so prolific. It was such a spectacular well in terms of the pressure, the gas, and the oil that came out. So what's happened now is they now have the technology that they believe they can safely drill that and produce the oil safely. So, it's been said before that the cure for the price of high oil is high oil, and high oil prices enhance technology, and we seem to keep finding more and more. In terms of exporting in other places, some of the people are pointing a finger right now and saying, hey, Trump's talking about putting in a tariff on oil. This is why we should have built a pipeline to Eastern Canada through Quebec, so we could export to more places in the United States. Our exports are heavy. Basically, oil is the bulk of our exports, and the bulk of that is going to the United States. We're very reliant on them, and there's been a lot of finger pointing because of that. So the idea is the idea among some would be to diversify it.
Definitely, but not to the extent that we are going to have a problem here, for example.
Yeah, and that concern, there's a lot of areas that concern can be expressed with, water, all those different things that, it's important to secure our national security, and we've already given up. We had some companies that had rare earth metal mines. We had some rare earth metal mines in Canada. We had lithium, and we've given that up to, China and other countries. And absolutely, that's a concern when you give away your resources. And I don't want to sound negative, but we're one of the countries that I would say is somewhat, our track record on that is somewhat bad of giving away important resources.
I concur.
Thank you, Barry.
We do have one other question. So Leon and Chris, thank you for the present. Is here. What is the outlook if there's a change in the Canadian federal government vis-a-vis like the impact of Trudeau's Liberal, vice versa? What is the impact if Trudeau's Liberal government remains in power?
So it's interesting. It's always a bit of a tough question, but I think so. Pedaling sideways a little bit. I think if you saw a change in government, and probably looking at Poilievre, I think you'd see the Canadian dollar go up. I would think that there would possibly be a better alignment with the United States, possibly, than there is currently. The idea is there will be more focus on unsustainable numbers in terms of and I don't want to sound anti-immigration here because I'm absolutely not, but some of the concerns have been, there isn't enough housing, rents are out of control, and the idea would be that there would be some curbs on that. But I think in general, the Canadian dollar and the Canadian stock market would fare better under a change of government, to be frank.
Yeah, I've actually listened to quite a bit as well, and I would argue that under a change in government, especially if it went towards more conservative government, there'd be a stronger emphasis on fiscal discipline. That seems to be the message that I keep hearing out of that camp. Is there any other questions out there?
Oh, you said earlier that this is recorded, and where is it recorded?
So anybody that would like, so two things, it'll be on our website, and then anybody that would like, we're happy to email out a copy of the recording, so to speak.
Yeah, so once it's on our website, we'll be sending an email to our clients, letting them know that it's up, posted on our website, and you can access it there.
Thank you.
Okay. Unless there's any other questions, just wanted to go through a couple things very quickly. So obviously the government announced the first home savings accounts that you can open up if you if you've never been a home buyer. So if you do plan on opening up a first home savings account, we're asking all of our clients to let us know by December 1st if they want one open for this year. So the ramifications are that your contribution room starts the year that the account is opened. So even if you don't fund it, by opening up the account this year, it means you qualify for the $8,000 contribution room for 2024. And then obviously once we flip the calendar onto 2025, you get an additional $8,000 in contribution room. So if you are planning to open up a first home savings account, we're asking all of our clients to let us know by December 1st. The reason being is that it does take time to set up. And so we wanted to make sure that we had some lead time there. Secondly, in terms of capital gains this year, as we kind of alluded to, it's been a fantastic year for us, especially on the stock side of things. So in terms of capital gains, it's going to be a little bit higher than average this year. And finally, for our ESP contributions, the deadline is year end. So if you're planning on making an RESP contribution for 2024, please let us know before the end of this year, preferably before the Christmas holidays would be great.
Yeah, so then thank you everyone for attending our presentation. Thank you for your support as a client, and again, attending the presentation. We know everyone's busy, and we really appreciate you taking the time out, submitting questions. Of course, feel free to call us tomorrow with anything we didn't cover. But yeah, we can't thank you enough for each and every one of you for taking time out of your evening to attend.
Yeah, thank you. That's perfectly on. And also, if we did our best to answer the questions on the fly here, if there was anything else that comes up, as Leon said, feel free to reach out to us via email or even the phone. If we touched on something and you'd like to go into it a little bit deeper, feel free to give us a call as well. We've been more than happy to discuss. Obviously, we try to keep things kind of relevant for everybody and not go too much into the rabbit hole. But as you can imagine, we dig into these things we can go pretty deep on any of these topics. So if anything comes up, please feel free to reach out to us.